Hello everyone, and welcome to FinWiser Advisory. In this course, we will be talking about financial modeling, DCF and comparable valuation. This course is divided into 16 modules. We are building a financial model on Tesla Motors. In Module 11, we will cover tax account. In this module, we will understand what is corporate tax, extracting the historical data from annual reports, creating placeholders for forecast period, calculating values in the forecast period. We will be using Microsoft Excel. In this template, there are two sheets named as Control Accounts 1 and Control Accounts 2, which step-by-step runs the user on how to calculate corporate tax. Historical income statement, balance sheet and cash flow created in the previous modules are available in this as well. Once the user completes a module, the final outcome of that is available to be used in the next module. Now, let's get started. Let's first understand what is corporate tax. Corporate tax is the tax that a company pays to the government based on the money it earns. Just like people pay taxes on their income, companies pay taxes on their profits. Imagine a company makes $100,000 in a year as revenue, and they spend $60,000 on things like employee salaries, rent, and supplies. The company's profit is then $40,000, that is, $100,000 revenue less $60,000 of expenses. If the corporate tax rate is 20%, the company will pay $8,000 in taxes, that is, 20% of $40,000 profit they made. So, after paying taxes, the company keeps $32,000 in profit. In this case study, the corporate tax account is set up in row 123 to 129 and includes the following components. 1. Total income tax in row 126 is the total tax payable by the company for the specific year. For historical period, that is, 2011 to 2013, this is linked from the income statement. For forecast period, that is, 2014 to 2018, this is calculated as corporate tax rate on profit before tax in cell range G124 to K124, adjusted for tax adjustments in cell range G125 to K125. 2. Corporate tax rate in row 127 is the regulatory tax rate for the country the business is operating from. 3. Effective tax rate in row 128 is the actual percentage of a company's profit that it pays in taxes, after considering all deductions, credits, and adjustments. It's different from the official tax rate because companies often use deductions or tax breaks that lower the amount of taxes they pay. For example, in 2013 company has a net loss of $71.4 million as mentioned in cell F129, and based on the corporate tax rate of 35%, the company will generate a tax benefit of $25 million in cell F124, calculated as $71.4 million times 35%. However, due to the impact of tax adjustments mentioned in cell F125, the actual tax paid by the company was $2.6 million, and the corresponding effective tax rate was negative 3.6%. 4. Tax adjustments in row 125 for historical period of 2011 to 2013 is calculated as the difference between total income tax as per corporate tax rate in cell F124 and the actual tax paid in cell F126. For forecast period in cell range G125 to K125, this is an input cell to be updated based on management guidance. Once the income tax expense calculation for the forecast period is completed, link the same to the income statement. Please refer to example in cell G28 on how to link data. That's all for now. See you in the next module. Have a wonderful day.